less 70%. This is the return year to date of one of the largest company in the entire world. But with this big discount, is it a good time at the moment to buy this business, or is it only the beginning of the shipwreck? Today, I'll share with you my stock analysis on the largest technology company in Canada, which is Shopify with the ticker SHOP. I will go in detail and make a full fundamental analysis on this company, but I will also take a look at what is their business model. And at the end, I will share with you a price prediction of this company to see if it is undervalued or overvalued at the moment. Now, let's jump right into it. Shopify is an e-commerce platform that helps small businesses to create and build their own online store, and those Shopify users can sell their different products and services to their different clients. This company saw the light in 2006 and was created initially by the Canadian Tobias Luke. In fact, the first ever website created on Shopify was created initially by them to sell their own snowboard. And at that time, there were no other options to different creators of websites to have the full control on their own website. Nowadays, this platform is used by businesses of all sizes, whether they are selling online or in retail. The Shopify merchant can create their own website online and sell on different social media, but also on different blogs and other platforms. This company went from a small company with only about 5 employees in a small coffee shop to about more than 10,000 employees all around the globe. Plus, now they are helping more than 1.75 million of businesses all around the world to create and customize their own online store. In total, in 2022, Shopify merchants will have over 500 million buyers. And as you can see, there is a great geographical diversification with the different online stores. However, the big majority of it can be found in North America. But you might be wondering how Shopify generates its income. In fact, this e-commerce platform is making the biggest part of their money throughout their subscription plans, which can be divided in 3 main plans. You have the basic plan for about $38 per month. Obviously, this includes an online store, unlimited products and services, and 2 staff accounts. After, you have the Shopify plan for about $99 per month, which has some slightly better features. For example, you can have some lower Shopify payments, but also some higher discount on this website. And finally, for about $299 per month, you have the advanced plan. And of course, this is the plan that has the most feature amongst the 2 other plans. But if you don't want to pay too much money and have a great plan to sell your products, you have the beginner and the starting plan for about $7 per month. And this gives you the opportunity to just sell your different services and products online on your different social medias. On the upper end, if you're a bigger business and that you're looking for more and some higher volume and other big businesses to sell to, well, you could go with the Shopify Plus plan that starts at $2,000 per month. All of these different services have helped this company to generate over $4 billion of income since the beginning of the year. Since a few years, you can see that this business has been able to grow pretty well, but in fact, as we can see with the evolution of the e-commerce between 2014 and 2024, this particular sector should see in the next couple of years an exponential growth. And as being one of the current leaders in that field, Shopify should have a great place in the future. But in that case, why does Shopify has lost so much value since the last couple of months? In fact, this can be explained by a bunch of different events. Of course, the current market downturn since the beginning of the year has had its impact on the value of Shopify, as we can see with the Nasdaq that is down of more than 30% since the beginning of the year. However, after the massive growth of the last 2 years, we've seen that with the reopening of different shops after the pandemic, this has had a tremendous bad impact on this company, as we can see with the growth and the bad result of the 2 first quarters of Shopify. However, for the 3rd quarter of 2022, we can see that Shopify has massively beat what were the expectations for them. Unfortunately, as we have been able to see throughout the 2 last years of full growth, this has had the impact to boost the value of this company a little bit too much compared to what it should have been. And with the volatility that the tech stocks have in general and that Shopify also have, this stock has been particularly hit by the revaluation of different tech companies on the market, and it's why this downturn on the market has been pretty bad for them. However, with all the predicted growth on the market for the e-commerce sector, this kind of company could be super interesting for anyone that is looking to invest in a long-term company. But now, let's see if the current valuation of this company is more interesting after this massive discount than a couple months ago. In terms of valuation, we can see that this company worth about $53 billion at the moment, with a super high price to earnings ratio of more than 245, which is quite higher compared to the average of the technology industry, meaning that this stock on that side is pretty much overvalued. The bad news about this company is that they are still not making a lot of money, as we can see by their profit and their operating margin, as well as their return on equity that is pretty awful. However, in terms of the revenue that are currently of about $5 billion on the last 12 months, we can see that they have been growing in the last quarter of about 20% year over year. And knowing that the interest rates are pretty high at the moment, the good news also is that this company sits on a lot of cash, about $5 billion compared to about $1.3 billion of debt. But we can also see that the risk represented by the beta is super high, about 1.88, meaning that this stock is almost 2 times more volatile compared to the average market. And we can see it by the 52-week change that is of less 76% at the moment, compared to the market that has been down of about 17%. As I told you earlier, as you can see here, the revenue of the company has been growing pretty well since the last couple of years, but unfortunately the total operating expense have also massively increased, which has had the negative impact to really decrease the net income of this company to a negative number at the moment. And unfortunately, we can see that with all those bad results from this company, the cash flow from the operation are also negative, which is different compared to the 3 last years where the cash flow were positive. And it also means obviously that their free cash flow are also negative at the moment. And finally, to see what is the project value of this company, to see if it is under or overvalued on that side, I've first decided by using the Peter Lynch valuation, that is a basic formula using the future growth of earnings per share plus the dividend yield that you divide by the price to earning ratio. And of course, this is knowing the fact that when you multiply the P ratio with the earnings per share, you obtain your current price at the moment. Knowing all of these information, we can see that on that side, this stock would be way overvalued at the moment, which is a lot linked, of course, to the IP ratio of this company. Unfortunately, for this second model, since the company isn't giving any dividend, you can't use the dividend discounted model. And finally, the last model that I've finished, since I don't have finished the 2 other models yet, is the discounted cash flow model. On that side, you need to first find what is your weighted average cost of capital, so what is your minimal return that you must obtain. And with this calculation, I've found that the weighted average cost of capital is currently of about 11%. After, with the estimate of the growth for the free cash flow, you can just multiply them, find your future free cash flow that are predicted, which actually give you your enterprise value. You add all the different equation over here, and in that case, you can see that the current price predicted for this stock at the moment is about $12 or $13, which would mean that with all of these factors, this would also be an overvalued stock on that side. As you've been able to see in this video, Shopify is a quite interesting and intriguing company that has, however, lost quite a lot of momentum since the last couple of months. And technically, this company is considered as an overvalued company with the different fundamental analysis and the valuation metrics. But if we take a long-term point of view, if you want to invest in a company that is a leader in the e-commerce sector, Shopify could be a great pick for you, especially with the people that are starting to buy more and more online and that are using more websites to go and shop on them. Shopify could definitely a way to go in that field, knowing that it's down of more than 70% since the beginning of the year. However, if you want to find some other big potential high growth stocks that could be pretty interesting for you to buy right now, check out the video that's going to be right over here. And if you're looking to learn more about personal finance, make sure to join the North family by subscribing to the channel for only $0.0, and I will see you soon. Peace.